When it comes to investing, the journey can be both exciting and daunting, especially if you're new to the world of finance. Many people think investing is reserved for those who already have a large sum of money to throw around, but that's a misconception. The reality is that investing your first $1,000 can be one of the best steps you take toward building long-term wealth. Whether you're looking to grow your money or simply start building good financial habits, the earlier you start, the better. In this guide, we'll break down the best ways to invest your first $1,000 without unnecessary jargon or complex strategies. This will be a straightforward approach that anyone can follow, no matter where you're starting from. Understanding the basics of investing. Before we dive into the strategies and platforms you can use to invest your first $1,000, it's essential to understand what investing is and why it matters. Investing is simply the act of putting your money into assets that have the potential to generate income or appreciate over time. While there are many ways to invest, the key is to find a strategy that aligns with your financial goals, risk tolerance, and time horizon. With $1,000, you have a solid foundation to start learning how money can work for you, rather than you working for it. At the heart of investing are two primary goals: to grow your money over time and to protect your purchasing power from inflation. The value of money decreases over time due to inflation, so it's critical to put your money in assets that outpace inflation. In this way, you can ensure that your financial future is secure. The power of compound interest. Before you start investing, let's discuss an important concept: compound interest. Compound interest is the process where interest earned on an investment is reinvested to generate additional earnings over time. It's one of the most powerful forces in investing, which is why it's so crucial to start early. Compound interest essentially makes your money work for you. The more time you give it, the greater the impact. It's also why even small, regular investments can turn into significant sums over time. Imagine you invest $1,000 today, and it earns a 7% annual return. After 1 year, you'd have $1,070. The next year, you'll earn 7% on $1,070, not just your initial $1,000. This cycle continues, and over time, your returns accelerate. The earlier you invest, the more you benefit from compound interest. The importance of diversification. One of the most important principles in investing is diversification. This simply means spreading your investments across different asset classes to reduce risk. If you put all your money in one investment, such as a single stock, you're putting yourself at risk. If that stock performs poorly, your entire investment takes a hit. With $1,000, it's essential to diversify to minimize your exposure to any single investment. Diversification can be achieved by investing in a variety of asset types, including stocks, bonds, real estate, or mutual funds. By doing so, you spread your risk and increase your chances of making money even if one investment underperforms. Stocks, the building blocks of wealth. Stocks are one of the most popular ways to invest. When you buy stocks, you're essentially purchasing a share of a company, making you a partial owner. Stocks offer the potential for high returns, but they also come with a higher level of risk compared to other investment options. The value of stocks can fluctuate wildly, meaning you could see significant gains or losses. When you're just starting, it's best to focus on well-established companies with a proven track record. These are known as blue-chip stocks. While they may not offer the explosive growth that smaller, riskier companies might, they tend to provide steady returns over time and are less likely to crash during market downturns. If you're worried about picking individual stocks, you can invest in exchange-traded funds, ETFs. ETFs are a collection of stocks, bonds, or other assets bundled together in a single fund. By purchasing an ETF, you're essentially buying a small stake in many different companies, which provides instant diversification. ETFs are often an excellent choice for beginners, as they allow you to gain exposure to a broad market index without having to pick individual stocks. Bonds, a safer investment. If you're looking for a safer investment option, bonds might be a good choice. A bond is essentially a loan you give to a company or government in exchange for periodic interest payments. Bonds are considered safer than stocks because they offer a fixed interest rate, meaning you know exactly how much you'll earn and when you'll get paid. However, the trade-off is that bonds generally provide lower returns than stocks. There are different types of bonds to consider, including government bonds, corporate bonds, and municipal bonds. Government bonds are considered the safest since they're backed by the government, while corporate bonds come with slightly more risk but offer higher returns. Municipal bonds, issued by local governments, are tax-free, which can be an appealing option for those looking to minimize their tax liability. While bonds are a more stable investment, they can still be affected by market conditions. For example, if interest rates rise, the value of existing bonds tends to fall. Therefore, it's essential to consider the current interest rate environment before investing in bonds. Real estate, a tangible investment. Real estate is another solid investment option that has the potential to generate both passive income and capital appreciation. However, buying property directly may not be feasible with just $1,000. Instead, you can consider investing in real estate investment trusts. REIT is a company that owns or finances real estate and pays out a portion of its income to investors in the form of dividends. REITs are a great way to gain exposure to real estate without having to buy property directly. REITs can be an attractive option for investors who are looking for income-generating investments, as they tend to pay out higher dividends than stocks or bonds. Additionally, they allow you to diversify your portfolio further, as the value of real estate can be relatively independent of the stock market. Mutual funds, a pool of investments. Mutual funds are another excellent way to invest your $1,000. A mutual fund pools money from multiple investors and uses that money to invest in a variety of assets, including stocks, bonds, and other securities. Like ETFs, mutual funds provide instant diversification, reducing your overall risk. Unlike ETFs, mutual funds are actively managed by professional fund managers who decide which assets to buy and sell on your behalf. While mutual funds tend to have higher management fees than ETFs, they can still be a good option for beginners who want to invest in a diversified portfolio without having to choose individual stocks or bonds. Keep in mind that mutual funds are generally a long-term investment, and you may need to hold onto them for several years to see significant returns. Robo-advisors, automated investment for beginners. If you're still feeling unsure about where to start, robo-advisors are an excellent choice for beginners. Robo-advisors are online platforms that use algorithms to manage your investments for you. Based on your risk tolerance and investment goals, a robo-advisor will create a diversified portfolio that automatically adjusts over time. Robo-advisors offer low fees and make it easy to get started with just $1,000. Many robo-advisors also allow you to set up automatic contributions, making it easy to build your investment portfolio over time. Popular robo-advisors include Betterment and Wealthfront. Setting your investment goals. Before you start investing, it's essential to set clear investment goals. Are you saving for retirement, a down payment on a house, or just building wealth for the future? The type of investment strategy you choose will depend on your goals, time horizon, and risk tolerance. If you're investing for the long term, such as retirement, you may be able to take on more risk in exchange for higher returns. However, if you're saving for a short-term goal, you may want to focus on safer investments like bonds or money market funds. Understanding your goals will help you choose the right investment strategy. How to minimize risk. While investing always involves some level of risk, there are steps you can take to minimize your exposure. One of the best ways to do this is through diversification. As mentioned earlier, spreading your investment across different asset classes can reduce your overall risk. Additionally, consider investing in low-cost index funds or ETFs, which provide broad market exposure and tend to perform well over the long term. Another strategy to reduce risk is dollar-cost averaging. This is a technique where you invest a fixed amount of money at regular intervals, regardless of market conditions. Over time, this can help smooth out the ups and downs of the market and lower your average cost per share. Investing your first $1,000 is a crucial step in building wealth. By following the strategies outlined in this guide, you can begin your investment journey with confidence, knowing that you're making smart decisions for your financial future. Whether you choose stocks, bonds, real estate, or mutual funds, the key is to stay informed, be patient, and let your money work for you over time. Happy investing!